This is my actual stock portfolio, and in this video, we'll be filling in this pie chart with the top 9 stocks to buy now, including one stock that's up 60% for the year but might be ready to double again, and one stock that Congress member Nancy Pelosi has been not so secretly buying up off the back of the CHIPS Act. So for transparency, let's take a quick look at my portfolio's performance over the past year. So we can see that over the past week, it's increased by about $19,000, but if we switch over to my old account, we can see that it's only up $8,000 over the past 3 months due to a big drop off, mainly from Crowdstrike. And then year to date, it's up a little more, and over 1 year, it's up just under $60,000. So around a 40% return. Not too bad. But with that growth has come a lot of volatility in this, partially due to individual stocks, like this drop is mostly all due to Crowdstrike, but also partially due to sector risk. I prefer to invest in companies in areas that I understand. And since I'm a solution architect for Fortune 500 companies, technology is where I'm the most comfortable. And for everything else, I have index funds. So as we go, I'll show you how much I have invested in each position, and at the end, I'll show you all my positions outside this list. So starting with a semiconductor stock that is benefiting from the current AI revolution, but unlike Nvidia, is only up 45% year to date and may have substantial upside from here. So when it comes to a new wave of technology, it's important to look at a company's products and not just their numbers, because outsized returns like investors in Nvidia or Microsoft saw over the past year only happens when you cross the right technology with the right opportunity before it happens. So Broadcom first came to my attention when I learned that Nancy Pelosi, one of the most influential and investing-prone members of Congress, bought into the company. This is especially important because Nancy Pelosi is very involved with the geopolitics of semiconductors, especially given the recent rivalry between the US and China in this area. But Pelosi buying a stock doesn't automatically make it a great investment. So let's look at what makes this company special. So Broadcom's a bit of a weird business because they're a semiconductor stock, but they also produce software and they provide services to other businesses. So let's use this chart to understand why Broadcom playing across all 3 of these areas gives Broadcom a competitive advantage. So this chart shows the waves of opportunity that come with a new technology revolution. This specifically is looking at the mobile internet, but we're seeing a very similar pattern today with AI. So back when mobile internet first came out, the first wave that we saw was in semiconductor stocks like Qualcomm and ARM, making the chips for mobile phones. The next wave of stock price increases we saw came from the actual infrastructure for these phones, in this case Samsung and Apple. And then finally, the biggest rise of all came from software and services that ran on top of this infrastructure. Broadcom plays across all 3 of these categories. They provide semiconductor material that is benefiting the AI wave. They provide the infrastructure and software that runs on these semiconductors, and they even offer the applications and services that can make use of this AI technology. So even though we've already seen a big rise in the stock price of companies like Nvidia with the first semiconductor wave, or Microsoft with the infrastructure wave, as these first 2 waves continue, Broadcom will benefit, and as the 3rd wave starts to appear, Broadcom will also benefit there, especially given how already involved they are with companies like Meta manufacturing the future of metaverse chipsets, and some of those Google AI chips incorporating a whole lot of Broadcom's technology. But AVGO is also the 5th largest company in the Nasdaq, so we might not expect as much price movement. So let's look at a much smaller company whose product is much more focused, who may be gearing up to join the 3rd wave of technology innovation with their AI-powered apps and services. So if you wanted to increase your stock investment by 35% basically overnight, then do it again a few months later, your best bet would be to invest in a company that is chronically underestimated by the market, who then has these huge jumps in price when they prove the market wrong with their latest earnings. So Mondaycom is that company. This is a company that's inventing the future of work, managing everything from a marketing platform to a task management platform to even offering CRM solutions. The idea here is anything that can make working more efficient could fit into Mondaycom's platform. And now they're starting to supercharge that platform with AI technology. What's really interesting about this company is how willing they are to work with other companies that might be considered competitors. They're very happy to integrate with any service that a customer might use, offer very specific products that they can upsell to existing customers, and of course provide them a good experience that lets them operate more efficiently than they would on their own. And because they're selling to businesses, once they land a customer, that customer tends to be very sticky in the future. This is one of the reasons that Monday has consistently managed to beat expectations. A year ago, their revenue was $189 million. Then 3 months later, it increased to $202 million, up 35%. Then 3 months later, they grew 33.5%. And then in their most recent quarter, they grew 34%. Every single quarter, their revenue is growing incredibly quickly, and their profit is growing even faster than that. This is a rare company that is a growth stock that is also growing their profits at the same time. Yes, they are reinvesting into making their products better, but they're also actually producing a profit, which could be important amid the current economic environment where investors want to see profits. So here's why I say Monday.com could end up riding this third wave of opportunity that is being created by the AI revolution. If we look at Monday.com's products, they range all across the different areas that a business would use. But if we just look at one area, for example, customer service, Monday.com's advantage here is they can take all the data that is being fed into a service like Monday Service and superpower it using the power of generative AI. Imagine a customer logs a specific ticket. Well, if it's something like a password reset, AI could recognize that and immediately send them the instructions to restart their password without it needing to go to a person. Typically in tech support, you have level 1 support, level 2 support, and level 3 support. Level 3 is like the developers, level 2 are fairly technical managers, and level 1 are frontline employees. By supercharging just the level 1 work with generative AI, one employee can do the work of 5 employees, which if the business is smart, they keep all those employees and they just make them 10 times as productive as they were before. That is the power that an AI application can unlock. And considering Monday.com has the right product, they're growing incredibly quickly, and they have that strong strategic positioning, this is a strong stock for the future, which is why I currently own 70 shares in this company valued at just over $18,000, which is up around $6,700 from when I first bought it, up 57%. And at the end, I'll show you exactly how much I have in every stock that I own. So I'm very glad I owned Monday this year, but next we have a stock I don't yet own, but maybe the rare AI value stock play in a market where it's hard to find cheap stocks with AI exposure that also make tons of profit and are perfectly positioned for the next technological wave. So I'm going to cover 3 areas of this stock: their AI capabilities, their cloud computing platform, and what's next for Oracle. So when it comes to Oracle, they're what's known as a cloud provider. Like the hyperscalers like Amazon Web Services, Google Cloud, or Microsoft Azure, they are built to run other companies' applications in their data centers. Now, Oracle has a way smaller piece of the overall market than a big company like Microsoft Azure, for example, but when it comes to AI, they're not as far behind as those numbers might make you think. So Microsoft famously leapfrogged Google in the AI space when they bought a large share of OpenAI, the creators of ChatGPT. But we're seeing more and more now that the quality of your AI model might not be as important as how people are able to use it. So this is actually Oracle's cloud platform. And if I were to search generative AI in here, I can actually open up an AI playground here where I can play with a bunch of different AI models built in here. These are open source models, so Meta's Llama 3, for example, which means they're totally free for anyone to use. But just because they're free doesn't mean they're worse than other models. Meta's Llama 3 is actually very competitive with OpenAI's GPT-4 model, performing slightly below OpenAI in certain categories, but performing far above them in other categories like Python coding. And so while Microsoft gets a lot of the publicity and the attention from having these GPT-4 models that the other cloud providers don't have, realistically, an Oracle customer can build just as good of an AI product on top of their platform as a Microsoft customer could. So just in the area of AI, while Microsoft has a $3.1 trillion market cap, Oracle's market cap is only $370 billion. So they're 1/10 the value of Microsoft, but they're certainly not 1/10 as capable in AI, which could be partially responsible for why they've increased in price by 31% year to date, actually outperforming Microsoft after that company's recent dip. But AI, when it comes to Oracle, is kind of just like their top of funnel. It can attract customers in, but where they're going to make the real money is all their other services. They have services to let you host a WordPress website or run your code in their environment. And it's these services that have driven the company's continued solid growth over time, with an 8% growth a year ago, followed by 5%, 7%, 3% in their most recent quarter, to a current net income, basically profit, of over $3 billion per year, which, if we were to compare to a company like Microsoft, Oracle's PE ratio is 21, which puts them on the slightly cheaper side in their industry, versus Microsoft, who's valued at a PE ratio of 31, making them one of the more expensive companies in their industry. So just based on its valuation alone, Oracle has potential. But let's turn to the most controversial stock of the video, a stock that's made me a 20% return in a few weeks, but that's only because I bought it during what I saw as massive overselling in the market. So the next stock is Crowdstrike, and because this company is so hotly contested in the markets right now, let's just look at the positives and negatives to investing in this stock and whether or not it'll rise 55% back to its high of $392 a share, or if it'll continue dropping. So given all the publicity that Crowdstrike has gotten, the first area we need to look at is their reputation. Crowdstrike is an extremely widely used cybersecurity company, and they accidentally caused a global tech outage, which is being caused the largest outage of all time, taking down things ranging from local city systems, 911 operations, entire hospitals. In total, the outage affected 8.5 million Windows devices, which all encountered the dreaded blue screen of death, which they could only recover by manually resetting the update that Crowdstrike accidentally pushed. This has had a very substantial impact on Crowdstrike's reputation, especially outside of the traditional areas where it works. If I were to say Crowdstrike to someone on the street, they immediately associate that with an outage. But public discourse doesn't always translate to profits. So in the short term, I think we can put reputation in the negative column. But short-term reputation doesn't always translate to long-term profits. So Crowdstrike has long set a benchmark for itself to maintain a 120% dollar-based net retention rate. Basically, for every $1 a customer spends this year, Crowdstrike wants them to spend at least $1.20 next year. This only happens when customers absolutely love your products and are willing to spend more money on it the more that they use it. And traditionally, Crowdstrike has had one of the best reputations in the entire business. Back in 2020, the SolarWinds hack became one of the biggest hacks of all time, and one of the few companies to fend it off was Crowdstrike. This was a hack that was so large that even companies like Microsoft were taken down, and the US Department of Defense. And because Crowdstrike customers were protected, they became the go-to name for quality cybersecurity products. And it's important to note that this outage was caused by a bug in the code, but it was not the result of a security incident or a cyber attack. So we'll have to see in the long term what the reputational damage to Crowdstrike is, but my belief is that in the long term, their reputation is still very solid in the cybersecurity space. But that of course brings up the second question. How good is their technology really? This is a company that pushed a bug directly to production on a Friday, which is like the 3 horsemen of how to break your code. So the full explanation for what actually went wrong here is fairly long, but I'm going to summarize. Basically, as part of the company's security process, they install a little agent on every computer to just watch what's happening. That way they can use their AI-powered cybersecurity to proactively recognize threats before they affect the computer. Rather than just looking for hacks that they've seen before, they can use pattern recognition to identify new hacks before they happen. The downside with this is you have to give that agent a lot of access to your computer. And a small update to one of the definitions in this agent basically caused Windows to notice an error. But because this wasn't a typical application and it was running at the core of the machine, an error here doesn't just crash your application, it crashes the whole computer. So the questions are, 1, why wasn't that tested and caught before? And 2, why did Crowdstrike have such advanced access to the computers in the first place? Well, the first area is the area that Crowdstrike can address. They can improve their processes to make sure things are tested better and try to find ways to avoid similar incidents in the future. But the second one I think is a bigger risk. Crowdstrike relies on companies trusting them enough to give them this incredibly delicate access to their machines. And it's entirely possible that companies are going to rethink this entire approach to cybersecurity to find ways to protect their computers without needing to give them administrative access over everything. But ironically, if that ends up happening, it won't just hurt Crowdstrike, it'll hurt the entire cybersecurity industry, which would be bad, don't get me wrong, but in terms of a competitive position, it doesn't put Crowdstrike worse than their competitors. Crowdstrike's mistake was almost so big that it's too big to just affect their company. Any backlash to this will likely affect the whole cybersecurity industry. So for this category, I'm going to put a negative for industry restrictions that could affect the whole cybersecurity market. And for the positive, I'm going to put technology, because CrowdStrike still has the best-in-class products. As their customers continue to spend more on the platform, and they are rated in the top right quadrant for endpoint protection by Gartner and the top right quadrant for cloud workload security by Forrester. But then there's the third and maybe biggest risk for the company. What effect this breach will have in terms of lawsuits and how it'll affect the core numbers and cash of the business. So one very public lawsuit is from Delta, who says that the chaos after the CrowdStrike outage cost them at least $380 million in revenue, and I've seen numbers as high as $500 million. And the company has said they are going to sue Microsoft and CrowdStrike to try to recoup this cost. So that is obviously not great for CrowdStrike, and in total they affected over 8.5 million devices due to this outage. But something I thought was strange is if we look at the overall estimated fallout of the event, so all the different companies that CrowdStrike affected combined, The Guardian estimated that this would cost Fortune 500 companies $5.4 billion, which is a lot of money and should absolutely cause the stock price to drop. But here's the thing, in the immediate aftermath to this IT outage, CrowdStrike's stock price dropped by 44%, a value of closer to $50 billion. So the market cut their valuation by $50 billion, even though every single lawsuit, assuming they lost everything, would only amount to $5.4 billion, which means the majority of the market reaction has nothing to do with the lawsuits. It's kind of a red herring. The real reason they're reacting is due to the reputational risk and the technology factors that we talked about before. So yeah, I'll put lawsuit in the negative column, but I'll make it really small because I don't think it's as big of a deal as some people are saying. And then tied into this are the company's actual numbers. So even after the drop, the company is still very highly valued. They have a PE ratio of 58. So as a negative, definitely put expensive. But at the same time, their metrics are very healthy. They're a 9 out of 9 in the F score, and their Z2 score puts them at very low risk of bankruptcy. So they have a bunch of cash on the books. So this combined is why I now own 116 shares in CrowdStrike at a current value of $30,000, which in total has made me around $12,500, up 71% overall. But what if you're someone who believes in cybersecurity, which is one of the biggest investing trends of the next decade, but you want a slightly less controversial company? So here are two quick stats for this next stock. The global cybersecurity market is expected to nearly double in size over the next 6 years, but the global cloud security market is expected to more than 3x in the next 5 years. That means if a cloud security company can just maintain their spot in the market, they would 3x their revenue over the next 5 years. But our next stock, ZScaler, can do a lot better than that. So there's 3 areas we'll look at for this stock: their products, their profits, and their partnerships. So in terms of products, ZScaler operates in the cybersecurity space, but unlike CrowdStrike, which is kind of an offensive company, this company is focused on the defense, specifically using the technology of zero trust security. So unlike a traditional company, which might try to protect the outside of their business with a wall, like a firewall, zero trust security believes that every application, every computer, every person on the network must authenticate before it talks to anyone else. This means that even if the bad guy gets into your network, they can't do anything without first being authenticated by the zero trust exchange. What's really important here is this is the way that all companies are tending to move as more and more companies move to the cloud. And ZScaler is an undeniable leader in this space. Their customers represent 30% of the global 2000. They secure over 400 billion transactions every single day, and they have a net promoter score of over 70, indicating their customers really like their products. But what might be more important to investors is their profits. So the company, if we were to go back a year, was making just under $500 million per quarter in revenue. But what was important here is they were growing incredibly quickly, both in terms of their revenue and in terms of their profit. The next quarter, they grew 39%, then 35%, and in the most recent quarter, they are now making $550 million in revenue, growing 32%, and more importantly, they produced the first quarter of positive net income with a 141% increase year over year. Now, this company isn't as big and stable as a lot of other companies on this list. They are very risky, which is part of the reason why their stock price hasn't done so great over the past year. With this big swing down, dropping the price by 38% before it recovered from there and ending the year down around 10% overall, giving it a current valuation of just under $30 billion. But the company's stock price does have strong momentum going forward, and they are riding the twin trends of cybersecurity and cloud growth. And given that cloud market growth, remember 3x over the next 5 years, that puts ZScaler in a strong position to maintain this growth going forward. And if they can maintain the growth long enough, that should allow them to start seeing more and more profitability build up within the business. But of course, that all depends on the third category of partnerships. So Moby has put a price target of $215 on this stock, and part of the reason for doing that is the company's strong strategic partnerships. Collaborating with the major cloud providers like AWS, Microsoft Azure, and Google Cloud, ZScaler has tightly integrated their security solutions into these big providers. So a customer of AWS can easily sign up to become a customer of ZScaler. So in some ways, ZScaler is kind of like Crowdstrike of a few years ago, hopefully without the big IT outage. They're still building up their reputation and growing quickly, and because they are now profitable, they could, like CrowdStrike, eventually join the S&P 500, an event that ultimately caused the stock price to soar around 25% for that bigger company, and could have a similar effect if Zscaler gets there in the future. So I currently own 82 shares in this very volatile stock at a current value of $15,500, and this is the first stock where I'm overall negative on the stock, down around 18.5%. So let's now swing maybe as far as possible to the other side. This next stock is not traditionally a huge innovator or super flashy company, and they've made several recent missteps, but those missteps may give us the opportunity to buy this stock at a value. So I need to set up the story with this one. So the day before Intel posted their most recent earnings, a Reddit post popped up on Wall Street Bets, someone saying they bought $700,000 worth of Intel stock using the majority of the inheritance that their grandma left them. This person wasn't a millionaire or a doctor, it was a junior in college. Somehow, this Redditor managed to have the worst timing possibly in stock market history, as Intel, a stock that's existed for the last 4 decades, managed to drop 35% in the immediate aftermath of reporting pretty dismal results, taking the stock out of the centi-billionaire club and putting the company back at the same market cap that they had back in 1997, which first of all is just the most unlucky timing in history, and 2 is crazy because according to YouTube, 10.8% of people watching this video weren't even alive when Intel first passed this stock price. Oh, and YouTube also says that 83% of people currently watching aren't subscribed, so if you're liking the video, hit that button below. I'd really appreciate it since we're approaching 100,000 subscribers by the end of the year, and I put a ton of time into these videos on top of working my full-time job. So Intel is obviously our next company, and I had 3 questions looking at this stock. Why did Intel drop so much? Are they a good value at the current price? And is the price likely to go up from here? So for that first answer, Intel has kind of dropped the ball in recent years. They totally missed the advent of GPUs taking over their traditional market, and chip makers like Nvidia and AMD absolutely blew past them in terms of their valuation. And if we look at the company's recent earnings numbers, they're kind of all over the place. A year ago, we can see that their revenue, their net income, their net profit margin were all dropping. Then they increased a bunch the next quarter, increased more the second quarter, and then in their most recent quarter, they dropped a ton. They lost $1.61 billion in net income. They had a negative net profit margin, and they only made $12 billion in revenue, which sure might sound like a lot, but compare that to Nvidia, which made $26 billion in revenue, and more than half of that became profit for them. Now, a lot of that could be down to just seasonality and the type of business they're in. They need to make big investments up front and then get paid back 10 years later. But I think investors are also scared about Intel's overall position in the market. They recently sold their stake in chip designer ARM Holdings, which is a company that's done fantastic over the past year, far outperforming Intel, and this appears to be a cost-cutting effort on the part of Intel. And anytime a business needs to get to cost-cutting, especially a tech business, it usually means they're not going to be growing their future revenue all that much. Okay, so that's why the stock price dropped, but are they at a good price now, or will they keep on dropping further? Well, if we look at the company's metrics, we can see that their PE ratio is 24.4, which is pretty decent. It makes them more expensive than the overall stock market, but they are a tech company. So compared to other semiconductor stocks, they're relatively cheap. And given their size, they're extremely cheap, especially when you consider that their price to tangible book value is 1.02. This means that if you were to break up Intel and sell it off for parts, you would get almost the exact same price as the entire company right now operating as one piece, which makes this basically the definition of a value stock. There's only one problem. Will the stock go up from here? I think realistically, if Intel exists for another 10 years, obviously the stock price is going to rise from here. But that could be a big if. If we look at the company's overall health, their F score is starting to drop down to around 6, and they are at a fairly high risk of bankruptcy according to their Z1 score. The company does not have very much cash, liquid assets on their books. Their firm's value is not great compared to the amount of debt and liabilities that they have, and all the assets that they hold aren't producing all that many sales. So why then am I putting this company on a list of top stocks? Well, I think there's a couple reasons to believe that Intel will survive this current dip and that we may be close to the bottom for this company. So first off, the US government has been very aggressively pushing for moving semiconductor manufacturing into the US. This is partially to offset the growing influence of China. But in July 2022, they passed the CHIPS Act. And in large part due to this act, US chip manufacturing capacity is expected to triple by 2032. And Intel is part of that capacity. In the past, when we've seen companies that are in a strategically important area for the US government get into trouble, we've often seen those companies get quietly subsidized by the federal government. And there's a pretty decent chance that if Intel gets into hot enough water, that they could get bailed out by the federal government. Now, don't get me wrong, it is a risk investing in this stock, but I do think that if they can continue operating long enough, they do have substantial upside given their current price. And hey, we can always just watch what trades Congress or Nancy Pelosi are making, and if they start to buy up this stock, might be a good time to buy the stock as well. Okay, but now let's get out of the old guard of tech stocks and into the companies reinventing the future of banking. And I'm gonna hit these two stocks quickly back to back before then getting to a stock that has increased in value by $500 billion over the past year, as well as showing you exactly how much I have invested in every stock that I own. So it's no secret that two industries move slower than pretty much any other: healthcare and banking. But SoFi is a company that's working to reinvent the banking industry, offering what they're calling banking as a service. So the way that SoFi is able to do this is by combining several different services that they have together. The company is really three businesses in one. They have their lending business, which is the cash cow of the company. They have their financial services, things like the SoFi app and SoFi credit card that bring in new customers. And they have their technology platform, the software as a service infrastructure that runs the rest of their business. Because SoFi now is officially licensed as a bank, they can use these product sets together to allow other companies to launch banks off the back of SoFi's platform. So in the same way that in the early 2000s, tons of companies popped up that let you build a website super quickly, SoFi is making it so you can build a fintech company just as quickly. But in order for that to happen, they need to continue to grow their reputation in the industry to get more people on board, which they're doing extremely effectively. Their number of members increased 41% year over year in the most recent quarter to a total of nearly 8.8 million total members. And these aren't members just using one one product. In fact, if we look at their number of products, they now have 12.8 million products being used in their latest quarter, up 36% year over year. SoFi's end goal? To capture the 500 million legacy bank accounts in the US and use their basically walled garden approach that they're kind of borrowing from Apple to give customers the best possible financial experience when they use all of SoFi's products together. So I've done a bunch of videos on this stock, and I currently own just under 3,000 shares of the company valued at just over $20,000. And this stock has been relatively up and down. It's currently up 6.78% in my portfolio. And I've basically been rebuying the stock whenever it dips below a certain level, because I really believe once they hit a certain size, they will reach escape velocity and basically transform the stock from a meme stock to a respected banking stock basically overnight. Because if we look at the company's valuation in terms of price to book value, they're currently valued at 1.19, which is pretty typical for a bank, but is around half to a third of what a fintech would be valued at. So the market still looks at this company as basically a loan provider, and they're not willing to give a multiple for the whole ecosystem of SoFi's products until they prove themselves by launching banking as a service for multiple other companies. And when that happens, I would expect this multiple to quickly increase, effectively doubling or tripling the stock price. But the US market is only a medium-sized piece of the world of finance, which is where the second fintech stock comes in. A stock that just had a 30% rise in their stock price after reporting earnings since my latest video. So the fastest growing fintech market in the world is Latin America. And this is a genuinely mind-blowing stat. The entire Latin America fintech market is expected to grow at 26% per year over the next 5 years, which means the relatively small current $16 billion value of that entire market would be worth over $50 billion per year by 2029. And Nubank is the Brazilian fintech company that is best positioned to win that market. So Nubank is the fourth largest fintech in all of Latin America, and they are the biggest in Brazil, boasting over 100 million customers, with 56% of the adult population of Brazil using their super app that can do everything from hold money to order delivery to get a car to pick you up. When we look at this company's unbelievable growth rate, as well as their very strong growth in profit year over year, my only concern has always been, will they grow so big that there's nowhere left to grow in Brazil? But that question has now been answered. So in their most recent quarter, the reason the stock price grew 30% is because they doubled their profit using two main techniques. Number one, they made more money per customer by offering more services to their existing users. And number two, they have been very successful at moving out of Brazil and into other areas of Latin America, including Mexico and Colombia. There has been a long-standing question of whether the Brazilian app would translate to another big market like Mexico, and it seems like, based on these earnings, that is now coming true. Given the company's amazing positioning in the Latin America market, given how well they are expanding in that market, and given that they are now succeeding at the one risk I was scared of, which is their ability to succeed in Mexico, I'm extremely happy with my holdings in this stock, which I currently own 1,200 shares in at a value of $16,000, which is up just under $6,000 and 54% since I first bought in. So hopefully some viewers got some of that 70% return the stock has seen year to date. But let's turn to this next stock that has made investors $500 billion year to date, and then I'll show you my full stock portfolio. So when I say AI stock, you probably think Nvidia or maybe Microsoft. When I say metaverse stock, you probably think Meta, Facebook. Both of these tech trends hugely boosted the value of the companies benefiting from those trends, even if the hype may have been premature in the latter case. But when I say reliable tech juggernaut, market cap over $3 trillion, who competes in both the AI and metaverse market and has over $60 billion in cash ready to deploy, you think, wow, that's a really specific list. And you'd be right, because that description only matches one stock, Apple. Now, there's a lot to like and a lot to question around Apple's business. So the company is typically not a first mover, lagging companies like Google and Microsoft in terms of their AI tech, although that could be a good thing in some cases. Plus, Apple's biggest individual investor just sold off $80 billion in the stock, though Warren Buffett claims that was for tax reasons. But here are 3 reasons I still think Apple is a very solid addition to a portfolio. Number 1, they have exposure to tech trends. If you missed out on investing in the metaverse trend or the latest AI trend. Apple tends to get their fingers into any new technology trend that's coming out. And so investing in this company is a fairly reliable way to get a piece of those trends, even if you're a little bit late. But that factors into number 2, which is stability. You can invest in Apple, which is inventing new metaverse technology, and they're using Apple Intelligence to incorporate AI. But you're not going to face the same level of risk that you would from investing in a smaller AI company, like the companies I covered in my top 3 AI stocks video. But most importantly, Apple has a competitive moat that it's hard for other companies to compete with. So in the tech space, most competitive moats are around some kind of secret, unique technology. Microsoft has their partnership with OpenAI. Nvidia has better chips than anyone else on the market. Apple has their famous walled garden and integrated tech stack. But Apple's real competitive moat is they have the most valuable brand in the world. Here's the thing about branding. It makes everything they sell more valuable by default. Simply slapping their logo onto something, even if it's fake or junk, would increase the value of that thing. But you combine that with a fairly high reliability of Apple waiting to introduce products until they're really ready for the market, has resulted in this perception of them as a reliable company. Whether it's misplaced or not, people tend to trust Apple, especially given their very privacy-centric approach. And people also assume that once Apple launches a product, it will just work, which is a big deal in a world when people are launching any product they possibly can. So I have exposure to Apple through my $200,000 invested in US ETFs, and here are the rest of the stocks in my portfolio. So if you follow me on Instagram, I just made a post that shows this full pie chart of all the stocks that I own, and I also post 3 separate stock breakdowns only on Instagram every single week, plus some behind the scenes content on what I'm working on next. And if you enjoyed this video, make sure to watch last month's video to see 7 more stocks to buy now. Ooh, should have bought more Palantir when I made that video.